Well, hello, friends and clients. This is Chad Roope, Chief Investment Officer here at Lineweaver Wealth. We hope you had a wonderful holiday season and Happy New Year. Today, we're going to go through our market outlook for 2026. A little view as to how we think the market should behave and what you should expect from the economy in 2026. So let's get started. First of all, we're coming off 3 consecutive years of very strong returns for U.S. stocks and bonds overall. Last year we had a strong year for stocks and bonds, and international, as measured by the MSCI EAFE index, was very strong after trailing the U.S. for many, many years. But U.S. equities powered by large cap growth technology stocks have had a phenomenal 3 years. So after all that, some may say, well, what shouldn't we expect a rough 2026? We don't think so. We think that the economy and the financial markets are going to do quite well. It's probably going to be a little more bumpy and maybe not quite as strong returns in 2026, but we do think it's going to be a pretty decent year overall. Let's first look at some risks that we're going to be monitoring closely throughout the year. We don't think these are extreme risks in any way, but we do think there are some things that we're going to be keeping our eye on that we want you to be aware of. First and foremost, we enter the year with valuation levels that are quite rich. The S&P 500 is currently trading at about 22 times expected forward earnings. And if we look at that number compared to history, the 30-year average is about 17. So we're a little north of one standard deviation above the average. And a lot of news headlines will compare this to the dot-com bubble back in the late 90s. When we were trading in similar sort of PE ratio multiples. And that's true in an absolute fact sense, but we do think that now companies that are leading our economy and leading the financial markets are generating a boatload of cash flow compared to then. So just a high PE ratio, while we would like it to be lower, it doesn't necessarily concern us as much as it would if we didn't have the quality of earnings and cash flow that we do. We'll talk more about that a little bit later, but on the whole, valuations are stretched, but we think we can overcome this with another year of strong earnings growth. The other issue that we're concerned about, as you'll see over here on the far right, you can see the top 10 companies in the S&P 500 right now account for about 40% of the index. And historically, that's been more like 20% if you look back over the last 4 decades. And the other issue is you got 3 companies that make up over 20% of the index, just 3 rather than 10. So we call this concentrated markets. And it is a little concerning, but again, the issue is that Apple, Nvidia, Microsoft, Amazon, Alphabet, all of these companies are generating boatloads of cash. So we don't think it's quite as big of an issue as might meet the surface, but we do think that perhaps this can begin to change in 2026 as earnings growth spreads out beyond just these top companies, which we'll talk about a little later. Something we're going to keep our eye on, though. The other reality is that 2026 is a midterm election year. And what we're looking at here in this blue line is the average midterm election year for the U.S. stock market dating back to 1950. The orange line are non-midterm election years for the U.S. stock market going back to 1950, the average year. Okay, so notice that the blue line is obviously lower than the orange line. Midterm election years, the total performance of the stock market, usually up and to the right, positive, like the 70% of the time U.S. stocks are usually positive, but less so. And we wouldn't be surprised if we end the same way. The other thing to notice here is that there's just a lot more volatility in midterm election years, particularly in the spring into summer, and then things usually do quite well. We think the year should end up quite well in 2026. We do think you're going to have some volatility, just like any other midterm election year, but it shouldn't be too bad overall because, again, as we'll see, I think the economy and earnings are going to pull us forward. Tariffs are something that's been creating uncertainty since last spring. April, it looked like the effective U.S. tariff rate was going to be on the order of 30%, going essentially from 0 to 30. That caused a tremendous amount of volatility in April and last spring. It looks like we're settling in somewhere around 15% and for a stated tariff rate. And by the time you get some of the exclusions in there, it's quite a bit lower than that. We do think that uncertainty around tariffs is still there. It's much less than it was. And we do think moving forward into 2026, we're going to get less and less uncertainty. However, we are paying attention to the Supreme Court. This has been passed on, the tariffs have passed on to the Supreme Court for ruling on their legality. You can see the timeline. We expect something here in the first quarter with some draft opinions. Something in June we expect for some final decision on the legality of the tariffs. We do think some form of the tariffs are likely to stick around, but we do think the uncertainty with them will continue to gradually move down as we move throughout the year. Now, sort of tied with that, in terms of political terms, just geopolitical tensions are high globally. Seems like every day we got a new headline. Recently, it's been with Iran. There's a tremendous amount of upheaval in Iran. We bombed, the U.S. bombed some of Iran's missile defenses last year. There's some talk that maybe there's some more retaliation with Iran. We took Maduro out in Venezuela. There's issues with ICE in Minnesota and everywhere else across the country. There's some talk about some action in Greenland. China's always forefront, recently saying that Chinese firms cannot use our cybersecurity companies. So there's a lot of geopolitical tensions. We do think that there could be some acute spells of volatility around some of this, but overall, just like we saw in 2025, we think the markets will get over it and focus on the economy and the earnings story. We're also watching the labor market. Now, this is a chart looking at job cuts each calendar year going back to 2015. Last year, we had about 1.2 million jobs cut. That's almost double what we experienced in 2023 and 2024. And quite a bit higher than the average here if you take out 2020 and COVID. Naturally, we saw what happened there, but the average here is much lower than what we saw in 2025. I will say that we had pretty low unemployment levels going into 2025, so it's not surprising that there were layoffs and the unemployment rate rose some, but we're just now getting back to normal levels of unemployment after being really low for a number of years coming out of COVID. So something we're continuing to watch. I guess we are concerned about the potential for AI replacing jobs, or are these permanent job losses, or are they temporary? Something we're going to be watching. Again, we don't think this is going to be a huge issue for 2026, but something top of mind for us. The other key thing that we're going to watch is the potential for China to disrupt the strength of the U.S. economic benefits with AI. So NVIDIA, Microsoft, Meta, all the big U.S. tech companies that are big in the AI space have been the leaders in the world, the innovators in the world. We did get a little shot across the bow last January when a company out of China called DeepSeek, released what they said is a version that can compete with ChatGPT at a fraction of the cost. That caused tremendous amount of volatility with technology stocks in January of 2025 through the spring. then it became clear that yes, and people like Jensen Wang with NVIDIA came out and said, hey, this is good news. It's going to help us all move forward. And the market sort of got over it. But definitely China is increasing its ability for disrupting AI globally and being a competitor to the US. And that could create some volatility throughout 2026. This top left chart here is just showing AI model performance in China going back to 2024. And you can see that there's quite a gap, but they are certainly closing the gap with AI model performance. This bottom left chart is just AI patents. Look at the red line, which is China, taking off. The increasing number of patents with AI within China compared to the rest of the world. Bottom right chart, China is becoming one of the top innovative countries in the world. That's not news, but certainly something we got to keep in mind. And China is building up a tremendous amount of their military around Taiwan. Now, why is this important? Taiwan is the center of a company called Taiwan Semiconductor, and they are the largest semiconductor producer in the world. They're a foundry, and they supply a tremendous amount of semiconductors to companies like NVIDIA and their Blackwell chips. So we are a little concerned here. You can see this middle column right here in this middle chart at the bottom. A lot of China's military is being built up around Taiwan. So that is something we're going to really watch as China continues to grow their AI footprint. We do think that this could create in aggregate, some level of volatility like we saw last January as news comes out. But again, we think that longer term, this shouldn't be a huge issue. And we do think the AI leaders in the U.S. can continue to do well in 2026. So those are some of the key risks we're looking at in the new year. But we think overall there's a lot of opportunity out there for growth. We think the economy is going to do pretty well, which should lead to some pretty nice returns for stocks and bonds overall. So let's get into some of those. What I'd like to start with, though, are geopolitical tensions and put some perspective around that. The chart we're looking at here is a chart of the S&P 500 from 1970 through the end of 2025. So the U.S. stock market, 1970 to 2025, up and to the right, as you'd expect, with this dark blue bar chart. Layered on top of that are all, a tremendous amount of the geopolitical crises and events that have happened since then. You can see there are a tremendous amount of them. But if investors were able to tune all that out and deal with the volatility, they were tremendously rewarded for doing so over that time frame. So we think in 2026, yes, you're going to have a tremendous amount of geopolitical headlines. Is it going to cause some volatility? It's absolutely going to. But if we can be patient, we can focus on our financial plans and tune out the noise, we think you're going to be rewarded by the end of 2026 if we don't get too distracted with geopolitical tensions. All right. Some other good news, and this is going to sound paradoxical, the U.S. consumer in aggregate is pretty gloomy. The University of Michigan puts out an enormous study on how consumers feel around the economy. And as you can see here toward the end of the year at the bottom right of this chart, consumers on aggregate were pretty gloomy at the end of the year. More than half saying, hey, we just don't like what's happening. We don't feel good. Interestingly, when we've had readings this low, you can see right here in the top left of this chart, the forward 12-month return for the S&P 500 has been excellent. So we think this is a good piece of news. We think with some things we're going to talk about here with the economy potentially improving more broadly in 2026, that this pessimism can actually turn into a positive thing for stocks. A big piece that we think is going to play into a stronger economy and strong financial markets in 26 is easier Fed policy. So we think inflation is going to be moving toward the Fed's 2% target throughout the calendar year. A lot of the shocks with tariffs around inflation is now behind us. We think that uh, inflation in real estate has been coming in. That's what the data is showing throughout 2025. Core services, the 6-month change of inflation you can see here in this chart coming down strongly through 2024 and especially in 2025. So what do we think? We think this means that the Fed is going to be able to continue to ease interest rates. They did in 2025. They're not going to be able to do as much, we don't think, in 2026, but another 1/4 to 1/2 of percentage points of cuts in 2026, which would get their Fed funds rate to near 3%. We think that that's likely, and we think that that's going to continue to fuel economic growth. And by the way, what they did in 2025 with interest rates cuts are just now going to be feeding into the economy in 2026. So we think easier Fed policy is going to be a tailwind for us. Additionally, the one big beautiful bill, the tax legislation, that's going to front load a tremendous amount of cash coming into the economy in the first half of the year. Tax refunds are going to be quite a bit larger than average next year, and the U.S. government is going to be spending a lot more money within their budget broadly. So we think broad fiscal stimulus is going to be a tailwind for the economy. Tax refunds is going to be put right back into the economy. And that could start changing the dynamic for the consumer confidence chart that we looked at earlier. And again, could be an indicator of why the stock market could do well in 26. Two unique factors for 2026 is the U.S. is hosting the World Cup. Some estimates put the economic value of about $20 billion there. And it's the 250th anniversary of the United States. So put all that together, and we think you've got some tailwinds for the economy in terms of fiscal policy and in terms of monetary policy. Now, AI, we think that there's going to be continued growth. There's been a tremendous amount of money spent on the AI build out and infrastructure through the last several years. We think it's going to actually accelerate in 2026 and into 2027. So this chart on the left is just the capital expenditures from Alphabet, Amazon, Meta, Microsoft, and Oracle, projected at almost $550 billion of capital expenditure just from these companies. So by the time you add on the data centers and all the electrical power grid build out, all of that together, some estimates of more than $1 trillion of capital expenditure going toward the AI build out in the US alone in 2026. That's going to be driving cash flow growth. That's going to be driving earnings growth and probably providing some broader economic benefits. On the right-hand side, we're looking at AI adoption. So companies that are not necessarily in the AI business, like an NVIDIA or a Microsoft or a Meta or an Alphabet, but older school companies that are adopting the use of AI to improve the efficiency of their business. So you can see in this top chart, ever increasing expenditures on AI subscriptions, and the bottom chart is AI agent deployment across businesses. So it was increasing significantly in 2025. We think it's going to increase even more in 2026 as more companies start adopting AI. And to us, that means higher margins for business. More efficient businesses means more earnings, means more cash flow to investors. So we think the AI story is going to continue strongly in 2026. We think the AI stocks that have been doing so well are probably going to continue to do well, but we think that because of this AI adoption, that the other 490 stocks in the S&P, not just those top 10 that we looked at earlier, can start doing better as well. So we think the markets could be broadening out to more opportunities in smaller large cap companies, cyclical stocks, mid and small size companies, and international and emerging market stocks as well. So diversification among our equity exposure is going to be important. It's been those top 10 U.S. stocks that's been driving the stock markets forward over the last several years. We think they're going to continue to in 26, but there could be a catch up with everybody else as well. All right, putting all this together for fiscal policy, geopolitics, Fed policy, AI, we think this is all going to lead to double-digit earnings growth, and that's what drives the stock market. As you can see over here on the far right, we're expecting about 12% earnings growth. That's in line with Goldman Sachs and some others. We agree that earnings are going to drive the stock market forward. That can help with the high valuation level that we looked at as one of our worries. You can see last year, earnings drove most of the gains in U.S. stocks. We think that's going to be the case again in 2026, and that'll help keep a lid on that high valuation level. Okay, so the bottom line is, sure, there are some risks that we are watching. Stocks aren't cheap, valuations a little extended, and we do have the market concentration issue. But we think that's going to broaden out in 2026. We do have midterm election years. Yes, they are absolutely more volatile than the average year. We shouldn't expect any different. And certainly geopolitical tensions are going to create bouts of volatility as well. China could come out with another DeepSeek in 2026. We should be prepared for those developments as we move through the year. And we are going to be watching the U.S. labor markets. But we think all of that can be overcome, and we can expect another solid year. Probably not like we've had the last few, but a solid year for stocks and bonds in the U.S. and globally, because we're going to have strong earnings growth supported by a resilient economy. Okay, we think the Fed can keep an easy policy because inflation is cooling. Another tailwind for the economy, and higher tax refunds and stimulus from the government, strong, easy fiscal policy. All of those are tailwinds for the economy, supporting earnings growth. And it's going to be fun because we've got our 250th anniversary and a World Cup. So the bottom line, we expect a good year, probably choppier than the last few we've had, probably lower returns overall, but still solid and good. And you can certainly expect from us continued proactive management of your portfolio and continued proactive communication, just like you've gotten over the last several years from us. So thank you very much. We really appreciate the confidence that you have in our team, and we love serving you. If you have family and friends that we can serve, there's no better compliment to us than a referral. So we would appreciate that, and we just look forward to serving you and your family in 2026. Thank you so much.